Welcome to our 2101 midterm review. I am Ying Liang and this is Seiga Samimi, and we two are going to cover this midterm for 2 hours on the exam. So how do we do? Do you find it hard or easy so far? It's okay. Not quite hard. Right. This covers the basic concepts and some of the calculations that we need to master for the midterm exam. And I will go over it and we'll refer to the slides or connect or all the materials that is involved for this question. And then we'll go deeper if we have time for different similar questions, but a little bit different. Question 1, so let's get started. Question 1 asked, what is most likely to be asked by a creditor? So the correct answer is A, but the confusing answer is B. Correct answer says a creditor is someone that's going to lend us debt or loan. Why B is confusing? Because it has the word credit there. But really, this is what the supplier should concern. This is the question we have for the Connect video. You should have done it if you haven't, because it's part of your homework. Just question 1 and ask the exact same question. And in the video, there are 10 different people that's going to make decision based on our financial accounting information, the reports we put out. The second one is creditors. So we have investors who's going to buy our shares. Creditor is for the debt, right? They only, consider whether you can pay them back the required amount, the principal plus interest. And the more you make goes to the investors. And we have customers who's gonna purchase our products. Suppliers, managers, employees, competitors, regulators, tax authorities, and local communities. These are the people. But then we ask the main, the main 5 are, you should have known by far. Question 2, which of the following is an alternative form of the accounting equation? My accounting equation is this one: assets equals liability plus stockholders' equity, A equals L plus SE, or some older version of the textbook, or some senior people would call it owner's equity, but really it refers to stockholders' equity. It's a different name. And then correct answer is A. We just switch the liability from the right-hand side to the left-hand side. This is the basic accounting equation. And if you see, choices B and D, it involves revenue, expenses. We do have another equation, which is the expand equation that covers the following. Right? You can find it in your textbook or the slides. The first line is our basic accounting equation. It always holds after every transaction. And then if we break down the stockholders' equity, we have left-hand side the common stocks, which are the money we get from the shareholders, so outside. And after getting the money, they own our stocks. They have a share in our company. And the other side is the retained earnings. This is the money generated from the company itself. So we sell products, we provide a service, revenue minus the cost, we have actual money, and that is retained in our company. The definition is revenue minus expenses minus dividends that we pay to our common shareholders. Whatever is left is retained earnings. And we call it, the second and the third expanded accounting equation. The reason we need to know this is sometimes we are provided information about certain items and then ask you, the one from the other. For example, if we have revenue, expense, and dividends, we are asked about retained earnings. You know where to find retained earnings. You use the last line of the equation. On the other hand, sometimes it will give us liability, assets, common stocks, and ask retained earnings. Then you should know we will start from the beginning. And we do have some questions from the review problem set about that uses this one. And so here is a recap of the accounting equations. Questions? So far, so good? Question 3. Use the following amounts to calculate net income. we have asset, dividend, expenses, liability, revenues. We need to find out where net income is. So going to the expanded accounting equation here. It doesn't say here, but how do I use my pen? But if I use revenue minus expense, we first get net income. Right? It's the net of these two. Now look at the questions. What the information provided is asset, and then we have dividends, we have expense, and then we have liability, we have revenue. So what do I need to calculate net income? Obviously, you know, from the very starting point, we have both. So simply just use revenues minus expense, we can get net income. All the other information is just to confuse us, but you have to know where it is. The questions can be more difficult in the midterm, so that we sometimes need this information to calculate it. All right. So revenue minus expense. Revenue is 82. And then we minus expense is 61. So therefore, it's easy to get net income, which is 21,000. Answer is D. Right? This is how we get it.
Will it consider dividends by subtracting it from expenses or from revenue?
If we subtract dividend from revenues, we will get retained earnings instead of net income. Net income is this two, net, right? So yeah, if the question asks retained earnings, then we have to do that. Question 4. The corporation begins the year with a 195 balance in retained earnings and a 320 balance in common stock. Well, we have retained earnings and common stock, so we know we are talking about the other side, right, of the equation. During the year, we generated net income. Well, net income is revenue minus expense. Now that instead of giving us revenue and expense separately, we have a net number, net income. And then we have additional common stock. So it's like a changing, right? We have beginning, we have what happened during the year, and then now we are asked about at the end of the year, what is the total stockholders' equity? Here is a sample, simplified version of the statement of stockholders' equity. We basically have everything here. So this is like a stock. So that means in the beginning, we have a balance, and this balance will accumulate to the end. This is the first year of the company, so everything is 0. Right? We have common stock and retained earnings. These two combined together is the total stockholders' equity. What will change is stockholders' equity? If we issue common stock, this will increase the common stock version, and then it will carry to the total line. Also, the net income, right, and dividends, net income is added, while dividend is subtracted. And these two lines are in the retained earnings column, which will also affect the total stockholders' equity. Now, the question provided us the beginning balance of common stock, of retained earnings, and then tell us what is changing for the common stock net income. So we just put it here, and then we can calculate the total, right? Just basically sum up together everything. And then if we have dividends, subtract dividends. If not, then it's 0, right? So we can just follow it. And I provided in Excel here. But we have 195 for retained earnings in the beginning and 320 for common stock. So I will just put it in. And the total would be these two sum up together for the beginning. And during the year, do we issue common stock? Yes, we issue common stock for $46. And then 28, wait, net income is 46. So net income here, right? And then 28 for common stock. Dividend is 5. So dividend needs to be subtracted. So I write -5 here, right? And the ending balance for common stock is these two sum up together. Same for retained earnings. We have the beginning 195 plus 46. And then dividend is subtracted, so I wrote -5. And then the total stockholders' equity would be the sum of common stock and retained earnings, which is 584. So once you are familiar with the table, the statement, all you need to do in the exam, just to memorize which one is added, which one is subtracted, and then you have everything, right? So you can just calculate it using one formula. So common stock is added, net income is added, only dividend is subtracted. And you have the beginning, you summed up the changes, subtracted the dividend, and then you will have the final number. All right, question? So answer is B, 584. Question 5. Which body has the primary responsibility for the establishment of generally accepted accounting principles? Generally accepted accounting principle, or GAAP, is the rule that every company has to follow in terms of preparing the financial reports, meaning annual report, quarterly report, everything. And to issue the rules, we have different different institutions. You have this AICPA for choices A. AICPA is for regulating the CPA, the accountants. What should be qualified as an accountant? What questions to issue, and do you have to have following trainings and everything? So it's basically for the regulation of the accountants, CPA itself. It does not have the authority to issue the rules for all the companies. So it's not A. B, International Accounting Standard Board. So this is about international, right? We are not talking about anything, specific about the international here. In fact, all we learn now for 2101 is only US. There are some minor difference in terms of treating several items, for different countries. So we have, in the US, the correct answer is D, FASB. Financial Accounting Standard Board, and the parallel institution for the international one is IASB, is B, but the correct choice here is D because we are talking about the US. A little bit of history. We all know about the Great Recession, and then in 1933 we have an act passed that is called Security Act. This one is for how to regulate IPO. How do we what kinds of firms can issue IPO and what are the process. And in order to do that, we have to have another institution to monitor these firms, which leads to 1934, the Security Exchange Act, that is the SEC. SEC has the power and the responsibilities to set the accounting and reporting standards. Now, look at the question. The question asks about responsibility only. This is a little trick because SEC has so much power, and it will not, issue the rules itself. Instead, it delegates these responsibilities to FASB. So our choice D. So FASB only has the responsibility to issue the rules to make sure this rules is up to date, but the power still goes to SEC. So if you see a question that asks what is the who has the primary power, then it will be SEC. Responsibilities, that's FASB. So these two are the main, institutions you have to remember. All right. It shows up in your chapter 1 quiz in Connect. I'm not sure whether you have any impression on it, but it should be fine. All right, question 6. Franklin Corporation has the following account balance at the end of the year. All accounts are listed. So whatever that's not in the table, we have a balance of 0, right? What is stockholders' equity? This is chapter 1 video question 18. So I list it whenever I can find the source, I will list it here. Stockholders' equity, that reminds us of the, the accounting equation expanded at the basic one, right? Just the, this slice here. Again, we have two choices. Either use the first row, right, the basic one. If you can find out what is asset, what is liability, then we have stockholders' equity. Or if we have more information, probably from here, then we will go backward and then get the ultimate answer of stockholders' equity. Now we are provided the accounts. So the first thing we need to do is to decide what these accounts are. Are they assets or are they revenues, expenses? All right, so let's go over it one by one. Accounts payable, what is it? Liability, very good. So I will put an L here. Accounts receivable, asset, right? These two are kind of, on the opposite side. Cash is easy, asset. It seems like we are probably going to the first line, right? It's all about asset liability now. Equipment, asset. The definition of asset is we own it first. Second, we're gonna use it to generate future revenues or future profits. Of course, we're gonna use asset to produce, the product, the goods we use. So it's definitely asset. Notes payable, liability. Salaries payable, liability. Supplies, asset. What is supplies? The notebook, right? The pen, every office supplies, or company supplies. Well, so we have 4 assets and 3 liabilities. And since the question says all accounts are listed, so we can purely sum them up, right? Sum up the asset and sum up the liability, and we think these, numbers will be the final amounts of asset and liability, and then we can calculate stockholders' equity. So total asset equals, I'll just write it down now. So the 23 from the second one, and then 35, which is cash, 41 equipment, plus plus the last one, 3. And that will be, let's do it quickly, 44, 78, 91, is it? Let's do it. Let me double check. 102. Yeah, what I'm doing. Totally miss it. 102 is the total asset. Liabilities. The rest 3, right? So it's 17 plus 29 plus 8. $54. Then we will use the first equation, asset equals liability plus stockholders' equity. So stockholders' equity equals assets minus liability. And then it's 102 minus 54. That gives us 48, which is the answer, C. So to sum up, the way we do these questions is first categorize the accounts listed. You have to categorize it either asset, liabilities, or common stock, or retained earnings. And then you can see the rule. Now is both asset and liabilities, so we get the Q of using the first line of equation and then get stockholders' equity. Next question, question 7. We borrows $40,000 cash by signing a note with the bank. Which of the following statement correctly shows the effect of this transaction on the accounting equation? Effect on accounting equation. So that means either increase or decrease, and then it tells us it's asset liability of stockholders' equity. This is very similar to our textbook, page 62, the transaction tool. So basically, textbook gives us all the examples about what are the possible transactions a company may face, and then what would their effects be on the accounting equation. And then later on, we will have another one about journal entry. Now that we know the effect, we have a set of rules in accounting to record the effects. Now let's apply the rule on this transaction and then record the journal entry, which is the next question. So we can go together one by one. All right, the first one, step one, again, to categorize the account. We know for sure there will be cash that is affected, and the other account, is note, right? Something about note for sure. And then we are borrowing money, so it must be liability, so it's note payable. So we have two accounts here. One is cash, one is note payable. And then the second step is to think about the effect. So we have cash. So cash increases or decrease? Increase, right? We have it. And how about liability? How about note? We have a note before we don't have it, so the note increase. Right, so both increase. And then the second step is now we know we have cash, we know we have note payable. And then what are their category? One is asset, cash must be asset. So asset increase, liability, the note payable also increases. And there's nothing about stockholders' equity, so it will remain unchanged. So this is the way we do it. This is kind of straightforward. Again, we want to reinforce the concept of this dual effect of an equation, a transaction, sorry. One transaction happens. Because of the design of accounting, we will always have two effects, dual effect. We have one time, we have the cash, we have more resources. And on the other hand, who gives us the cash? Is it from our shareholder that will lead to more common stocks? Or is it from the debt holder? So nowadays it's the bank, so it's the liability side, right? So two effects. Sometimes we will see more than two accounts to be affected. That will be covered later in other questions. So this is the first step, right? We know what accounts, we know the category of the accounts and the effect of the account. All right, next question. Now we're still about cash. But then now we move to whether it's debit or credit, right? Well, it's purchasing office supplies for $350 cash. How would the transaction be recorded? Because it's a multiple choice question, we basically know what the account names, right? It's like from the choices, we know one must be actually, no, there is inventory or supplies and cash. Cash shows up in all the four choices, so it must be correct. And the other side is either inventory or supplies. When we purchase office supplies, does it count as inventory or does it count as supplies? Supplies is like, it has the name supplies in it. But well, unless you are selling the supplies, on the other hand, it wouldn't be counted as inventory. Right? Inventory is something you're gonna sell it later as like your main business. So it tells you this is office supplies, so it's supplies. So it's either C or D. Now it's a matter of debit or credit. So again, first, we have to decide the category of these two accounts. And we know cash must be assets. How about supplies? We covered it before, also assets. That means we use asset to trade another asset in, right? So both are assets, that's fine. We just go and find the rule of asset. How do we record assets? This is a very nice summary from main slides. When we talk about debit credit, we have to first, draw a T account. So all we know for debit now, well, it comes from a Latin word. It's actually in the oldest Italian, the double entry book. But nowadays, debit only means the left side of the T accounts. It doesn't mean anything about increase or decrease, because if for different accounts, it means different meanings. So it does not. Don't link it to increase or decrease, link it just to left or right. Debit means left, credit means right. Of what? Of the T accounts. And then later on, when we get rid of the T accounts, you just memorize it. You draw a T account in your mind. And debit means left, credit means right. And then we have the rules for the T accounts. For asset, which is the left-hand side of the accounting equation, every account in asset, we put increase on the left side of the T accounts, and we put decrease in the right-hand side of the T accounts. For these two, increase is instead on the right-hand side. So you memorize one thing, you know all the others are the opposite of it. In fact, if we go deeper, when we expand the equation, right? Before we were looking at this one, and then when you expand it, there is a minus sign in front of expense and a minus sign in front of dividends. So these two, expense and dividends, they follow a different rule compared to all these sides, right? You see, debit is the left-hand side is actually increasing. So these two follows the rules of asset, and all the rest follows the rule of liability and stockholders' equity, simply because they have a minus sign. They go the different way. And that is where the dealer rule, if you have watched the Connect or the videos, well, it's an old rule. People have different tastes on it. Dealer means D-E-A. The first three letters follow a different rule. And then L-O-R, L, owner's equity, the old way of saying it. Right? R, revenue, on the other way. But if you see the picture, you have a vivid memory. This is something, unfortunately, we have to memorize. Think about accounting as a language. This is what we have to memorize as the rule, the grammar of the language. But the good thing is we have some, visualization in it. Well, going back to the question itself, since both cash and supplies are assets, so we only need to find out assets. And one increase, one decrease. Left-hand side means increase and it's debit. Debit means left-hand side. So we debit the increase and credit the decrease. And in this case, we are buying office supplies. So cash increase. Sorry, cash decrease because we are paying it for cash. And supplies increase. And since increase, we use debit. That's why we debit supplies. Debit because it's on the left side. Credit because it's on the right side of the T account. Right, that's another way, a further step of doing accounting journal entry. But do go back to review the slides. It's very important. And for the midterm, it definitely will show up, multiple questions. And then for the final, this is like the basic. You have to learn it. But again, debit just means left. All right, now we move on to chapter 2, right? Which of the following is possible for a particular business transaction? Well, it's hard to just look at the choices and then come up with transaction and show yourself that this is possible. The correct way of doing this question, at least what I do it, is so think about what is impossible, right? The impossible thing is, in accounting language, is that after this transaction, the equation A equals L plus SE does not hold anymore. That means, the left-hand side and the right-hand side is not moving the same. You cannot, go up for one side and then go down for the other side, then the equation is not equal anymore. So that's the way we do it. And now we have the increase, decrease. We will just put it in and see whether it is okay, right? So asset is the left-hand side. For A, asset increase. And then you, I cannot do this. And then decrease of liabilities. It's not possible, now that you can see, right? You cannot just increase for one side and then decrease the other side. Same for B. B, we have a decrease in asset, but we have an increase in stockholders' equity. But C is good, because both are decreased, right? Sorry, here. And D, one is decreased, one is, wait, when I increase my expense, what would happen? Very good, because there is a negative sign here. This is increase, and then I flip it, and eventually it will affect stockholders' equity. Oh, sorry. This is decrease in liability. So only the right-hand side changes, the left-hand side doesn't change. Right. So again, doing these questions, think about the equation. Does the equation hold or not? This is the rule of doing it. Question 10. Providing service to customers on account for $100 is recorded as, so journal entry, recording, right? And the key word here, on account. We have seen it before. On account means an alternative way of cash. So it can mean both receiving cash or providing cash or giving out cash, the alternative. Right? And now we are providing service. So we are the one who is entitled to get cash, right? So, but we haven't got it. And that means we have something that is we are going to receive cash in the future. That means accounts receivable, right? So we're gonna put it in accounts receivable. On the other hand, if we buy, say, office supplies and we haven't paid money, what is the alternative account to cash? Accounts payable, right? So two things may happen when you see on account. So make sure you can find out whether it's accounts receivable or payable. Here is actually very similar to our textbook, page 66. Again, there's 8 transactions, transaction 7. You can go back and take a look of how they analyze the transaction. And also, Ming's slides give a very good steps here. They also have a different names of the company. This one provides golf training, $2,000. And first you have to think about what accounts involved. Accounts receivable, now you're providing service. So it's service revenue, is something that you are earning, right? And then you think about the journal entry. What are the changes of each account? You have more money to be received in the future, so it would be increased for accounts receivable. Same thing for a revenue increase, and then go back to the T accounts with debit credit in it, left right hand side, which is here to give out. All right, cash instead of cash. Sorry, this should be accounts receivable, but both assets, left hand side for increase, so debit. Revenue, you increase it on the right-hand side. Right means credit, so credit. And we have one debit, one credit. Very nice, and that's how we do it. All right. So answer is A. We debit accounts receivable and credit service revenue. Although the choices do not provide the word debit or credit, but you can see the indentation, right? And also, we always write debit in front on the first row. And then if you have more than one debit, for example, you have 2 accounts, both are debited, they too will have the same, they too are aligned together. And then you see a little like indent here, that is for credit, right? And it is written on the bottom. So debit credit, that's the way we do it. Next question. Well, we talked about it before, right? Debit only means left-hand side nowadays, and it's the T account's left-hand side, and I just provided it here. Question 12. Which of the following statement is true? First, in a journal entry, there are 2 amount columns. Left hand is for debit, right is for credit. Yeah, that's just basically question 11. So 1 is correct. Choice 2. in a journal entry, the account to be credited is listed on the first line. Now, the opposite, debit is the first line. Third, in preparing journal entries, it's acceptable for the amount of total debits to be higher than the total credits. Then the accounting equation cannot be balanced after the transaction, so wrong. Well, that leaves 1, and then 4 haven't read it, but judging from the choices, you know, it must be B. Choice 4, in posting transactions to a T account, debit are posting on the left, credit on the right. That's basically 1, and then you say in a different way, right? Left, right. I can see Ming is really reinforcing this debit credit concept in it, so make sure you understand it. Maybe there will be a question in the real midterm. Question 13, during a discount sale, Larry buys a CD from Best Buy. Rather than paying cash, he uses the credit card on account. Right? Sometimes, you know, if we are not sure about how we treat credit card payment, because it's really short term, you don't know whether it's your notes payable or accounts payable. Now the on account gives you assurance. It must be something starting with account, and then since it depends on which side of the party you are talking about. Now it's the questions about Best Buy. So Best Buy is the one that sells product, and Best Buy is expecting cash. So that means on account we are talking about accounts receivable. Huh? But then, well, the emphasis here is accrual basis of accounting. How do we record revenue at what time? Right, accrual basis, we have 2 choices now. System 1 is accrual basis, the other is cash basis. The simple way is accrual basis is how we do financial reporting. Cash basis, we don't talk about it. It's not allowed in GAAP, the US rule. So let's learn about the difference. The main difference is about timing. When there is transaction happened, but cash is not along the way, so there are the difference in the timing. How do we record things? And then Ming provided a very nice rule for each one. You know, how do we record revenue? How do we record expense? And there are 2 different systems here. Now, since we are talking about Best Buy is, you know, recording revenue. So there is a rule. Let me put it all together. For revenue, accrual basis, we have a main rule, revenue recognition principles. And, you know, revenue must be, you know, accompanied by expense. So the second rule, very important in our accounting on this semester, expense recognition. So 2 things. These are the basics of accrual basis accounting. For revenue, we recorded it when goods and service are provided. So the day we sell things, the day we provide service, that's when we record revenue. How about expense? Expense are in the same period as the revenues. So if we use the building to generate revenue, and this month's rent for the building must be matched to this month's revenue. That's the matching principle or expense recognition principle. So you can't use next month's rent and then put it in this month and say this is what we cost for to generate the revenue. No, it's for the future, so we have to separate it. Right? That's what that's the expense recognition. And going back here, so C makes perfect sense. At the time we sell the products, we have to record revenue because it's under accrual basis revenue. How about cash basis accounting? If I change the question to under the cash basis of accounting, what is the correct choice? Very good. So cash is really easy. Same for the expense. It's only about cash. When do you receive cash? So question 14, here is the cash basis accounting. I highlighted it. On March 4th, you provided service, and then this is $200. Doesn't matter about the money. Green Lawn provides maintenance on March 8th. Oh, okay. So March 4th, you only asked for it. So they didn't do it. And Green Lawn did it on March 8th. And then Takawa pays it on March 12th. Under cash basis, so look at the cash. When do we pay cash? March 12th, right, the last date. So it's C. And this is like, we asked the other side, the expense, right? The previous question is revenue and accrual, and now it's expense. For cash basis, regardless of revenue or expense, just look at cash. But for revenue base first, for accrual basis, look at the time it happens, right? So that's it. Do I have extra? Oh, I do. This is main slides. If you have seen it, these are the exercise he provided. We can do it together since we have more time. So expense recognition, accrual versus cash basis. We provided 3 different transactions, and let's see whether we should record under 2 different systems on the exact date, right? So December the 1st, pay 1 year of rent in advance for $6,000. Should we record it under accrual basis accounting? The date we pay, and which is in advance, that means we haven't used it. We have not used it, right? So that is not expense. We should not record it. When we talk about accrual basis, we only refer to revenue or expense. Of course, we pay money. We have to, say cash decreases, but that is not, that is not what we talk about. We still do a journal entry, but it's not expense now. We should put it in prepaid expense, which is an asset. A key word here is in advance, right? But under cash basis, we do record expense, right? Because it's only about when we see the cash. December 28th, we pay salaries per day, and Eagle pays $28,000 for the first 28 days of December. All right, so it's December 28th, so they pay the past 28 days. Should we record it as salaries expense under accrual? Yes, because it's happened, right? It's for the past 28 days, so we should record it. Cash? Did we pay? Yes. Did we use cash to pay? Yes, so both should be recorded. The last question, it does not pay employees for the last 3 days until January. Well, Eagle does not pay employees for the last 3 days until January. So that means on December 31st, no cash, because it's not happening until January. Now, under accrual basis, yes, it is. In fact, this is very important at the end of the year, because we start to, separate 2 years, and then we have to prepare the whole year financial report for the year. So we have to, check whether we have unrecorded expenses, and we have to, adjust entries to do it. So accrual basis, yes, for sure, because it's happened. It's for the past December. We use the employees to generate profit for the December profit. So expense should be matched to the revenues generated. That's why we using the matching principle, expense recognition principle, right? Different names. We should record it. But cash basis, no cash out, so no recording. All right. Recap for this one. Let me write it down. We pay in advance, so we don't. But since we pay cash, it should record it. Keyword is in advance. And then since it's the first 28 days of December, and now it's, the timing, so we should record it. And for cash basis, because we have paid cash, so definitely record it. The last day is not paid until January, so no. But since it's, it's the end of December, so everything has happened, so we have to record it. Remember the criteria for these two. Question? Okay. I think we can go back and do this. I also provided the revenue recognition, again, cash and accrual. But same rule, right? December 12th, provide training to customers for cash. Well, we have cash, so this one is easy, definitely cash. And what is the rule for recording revenue? When we do it, right? When we provide service, when we sell the products, and we are doing it, so definitely recording it, revenues here under accrual basis. December 17, provide training to customers on account. On account means no cash, so cash basis nothing. But since the the wordings are the same for accrual, so definitely record it here. The last one, receive cash in advance for 12 golf training sessions to be given in the future. So haven't provided service, no revenue recorded under accrual basis. But since we have received cash, under cash basis, we only look at cash. So we should record revenue under cash basis. All right, that is smooth. So yes, it will move. Yes, yes, no, no, yes. Okay. That is I think we will be fine given this training. All right, question 15. These are again about timing, adjusting entries. On July the 1st, Charlie Cole paid $18,000 to rent an office for rent, covering 18 months from the day we pay, right, July to December 2019. What adjusting entries should Charlie Cole record on December 31st, 2018? Again, since this is the end of the year 2018, we have to adjust whether we have reported everything, because we have to prepare the financial report and tell people this is what happened. So we go back and look at it. Well, you see December 31st falls in the timeline on the renting period. So we have to calculate how many months of rent have we used and how many haven't. And we have to record the months that we have used the rent and then record it as expense to put it in 2018's financial reporting. This is the timeline. We paid the rent for $18,000 on July 1st. And then we use the rent all the way until December 31st. But right, the lens is not matching, but don't judge me on these. So we have one more year left for that haven't used. So we shouldn't do anything on this part because it's not passed, but we should do the part here. First, the rule is how many. The way I calculate things is first I will calculate what is the monthly rent, how much is it, and then I calculate how many months has passed, and I use the first one, the dollar times the months, and then we get the total amount, right? This is from July 1st to December 31st. This one is good, 12 months, right, from December to December. How about here, from July to December? How many? 6, very good. So we have 12 plus 6, 18 months. And we pay a total of $18,000. Well, it's easy, $1,000 per month as the rent. And then the 6 months has passed. So 6 times 1,000, the total here we should record is, I'll put it here, 6,000. Right, let's put a dollar sign here. 6,000 to be recorded. So A and B, choices A and B are ruled out, right? It's either C or D. Now, 2 accounts, prepaid rent and rent expense. One is asset, prepaid, right? The other is expense. So when expense increase, we have to increase expense. Now, do we put debit or credit? I use the rule dealer. E is in the first part, so it's debited. Debit, rent expense. That's how I do it. And then prepaid rent is an asset. You are decreasing an asset because you don't have that much prepaid left, so it's credited. So that's why we choose D. But I want to do the journal entry for this day. This day we did it, and this day together, so that you know how things happen. Since we have time on it. So for July the 1st, what journal entries should we record it? We pay cash, but we haven't used the rent. So these are the two things. We pay cash. Cash decreases. Cash is one of the account. The second one, since you all know, it must be prepaid rent. So two things. Cash is decreased, so cash must be credited. I always write the easy one first, regardless of whether it's debit or credit. And the other one is debit, and we know it's prepaid rent. And that is also for $18,000. This is what we do the journal entry for July the 1st. And December 31st, 2018 is what happened here. So look at the choice, correct choice, right? We sort of like move $6,000 from the prepaid rent account to expense. So after that, my prepaid rent still have a debit amount of 18 minus 6 equals $12,000. This is gonna be used for next year. Choice D. And then 2019, December 31st. Now, moving to the last part, what do we still have? We have prepaid rent of $12,000 left, and we have used this. So we're gonna decrease prepaid rent to 0. On the other hand, the corresponding account is still expense, right? Because we use the rent for generating profit, so it's kind of it's an expense. So still two choice. Same thing for this. It's just the amount is different. Instead of 6,000 for next year, it's gonna be 12, and then 12. Right. So here is all the 3 important dates for the rent, and this is how we do the journal entry. It's not hard. We have 3 accounts involved: prepaid rent, cash, and rent expense, 3 things. All right, question 16. We took a 1-year, 8%, 100,000 loan on March 31st. Interest is due upon maturity of the loan. So it's a 1 year, and the maturity is gonna be March 31st, 2019, right? 1 year from now. And the loan and expense must be paid back on, that's what I said before. As of December 31st, again, the end of the year, we have to recognize revenue. That's why we still have to calculate, the rents here. But the good thing here is the key thing for interest is that we will pay the interest upon the maturity of the loan. That means in the end of the year on this date, we are not paying any interest. But the thing is, interest have been accumulated, and this year's interest, 2018's interest, should be allocated to 2018's financial reporting. That's why we have to record just entries. And interest is also part of an expense, right? We have an account called interest expense. This is because we need to borrow the money to generate revenue. So, the cost along this borrowing should be part of the expense for this year. So what we do here is, again, what is the monthly interest calculated, and then how many months have passed, so we get the amount of the interest. What amount should it report for interest payable? Now, why is there a payable instead of interest expense? This is usually the question I get, and that's why I want to do all of them, the 3 days, one by one, and then we will see the corresponding thing. So on March 31st, we have more money, and the total amount we borrow is 100,000. Why is it not moving? Okay. Debit cash for 100,000, and then credit. That will be our loan payable or no payable. Yeah, let's do loan payable, and same amount. On this date, since From March to December, how many months? 9 or 10? 9, because it's March 31st, so the first 3 months have passed. So it's used 12 minus 3. So 9 months, each month, how many interest? Formula 8% times 100,000. This is the total interest, right? And then this is good for 12 months. And then I would use this to times 9 divided by 12, right? Monthly interest is, let's do it this way. This is monthly interest. And then 9 months. So the total interest for 2018 is Is it this? 6,000. Thank you. Yeah, thank you. And we know for adjusting entries, one rule is either revenue or expense to be adjusted. So this time we have to pay something, it must be an expense. And the other side is some account related to this one. Since we are not paying cash, for the interest, there must not be cash. And what is the alternative of cash? It's always account something. And here is expense, so something we need to pay. That's why it's accounts payable. And accounts payable is a liability. Sorry, it's not accounts payable because it's interest. It has a name, so it's interest payable. The first one is expense, goes to income statement. The second one is a liability. So the dual effect means now we recognize an expense. This is something needs to be generated in the income statement. This tells us what we have used to generate revenue. On the other hand, who is gonna claim it is our debt owner. This is who's gonna claim it. This is what we used it for, the dual effect. That's why we have an interest payable. So yeah, I have an extra S. Interest payable showing up here for the 6,000, and that's what we get the correct answer. Now the last one, this is actually December 31st, 2019 is the most tricky one. I want to do it so that you know, in case you have seen questions on it. So on the last date, we pay everything. We pay the principals, we pay the interest, and we pay them together. And we pay it by cash, so cash must decrease. And then we, on the other hand, we have used it for this year, and also it will be showing up as an expense. But last year, we generated a payable. We have to remove the payable as well. We have to move it, because we are using cash to replace this payable. So actually 3 accounts involved here. One is cash, the other, second, is the expense, and the third is we have to remove the amount from payable. So 3 accounts. Cash is the most easy one, so I always start with cash. But this time we are paying our cash, so it's a credit, right? Cash decrease. And the amount is gonna be my principal, which is 100,000, the loan, plus the interest. Interest is 8% times, 100,000. So it's 8,000. 8,000 times 100 plus 100, so it's 108, right? Debit. There are 2 things to debit it. First, because expense is always debited, and we debited the previous one. Now we debit the new one. This is for 1 year, and it's gonna be, actually it's more than 2. Yeah, three things. Let me think about it. So I separated this 108. Right? This cash is 108. It composes three things. The first is the $100 from here, the loan payable. I forgot this part already. Is we have this account and we haven't touched it for the whole year. This account has $1,000. Now that we pay it back, so loan payable should be reduced by $100,000. So we have to remove this one before it's credited. We do the opposite. So the first thing we do is to debit it. Now we did this to refer to the first one. And the second line, interest payable, is referring to this part. We have this account liability, we need to remove it. So do the exact amount. We have 6,000 here before, so we debit 6,000 so that this part cancel each other. The third one, the last one, interest expense, is for the last months happened here for 2019, how much we allocated it. We can calculate this number by using monthly interest times how many months has passed, but we can also do it by subtracting these two from the 108 and get what we have here. This is the latest, the most difficult one, and I want to reiterate it again. Why do we have loan payable and interest payable carry forward from 2018? Because they are liabilities. Liabilities is in balance sheet. Every account in balance sheet will carry forward. How come we don't need to take care of the interest expense that we had in 2018? Because it's in an income statement account. Income statement do not carry forward. Income statement account will become zero in the beginning of each year. So we don't have to take care of it. It already shows in the previous year. That's why we do this too, and this 2,000 is for the new year, right? So these are the three, and then we pay cash. Sum them up, that's what we paid. This is a very classic one. Now this question asks the middle one, which is relatively easy, but make sure you understand all the 3 days journal entry. Closing entries, that's what we slightly touched before. We close the temporary accounts to retain earnings account. Correct answer is D, and we have a whole slide talking about it. We close entry at the end of the year. Again, we close the entries. That's why we talk about the expense, right? Expense do not carry forward. Same as expense, revenue, dividends do not carry forward as well. And these colored words are how we do closing entries, journal entry of it. We do debit all everything, because before all the balance are in the credit side, we do the opposite. And then, since we have temporary accounts, we should have permanent account as well. And these are the permanent accounts. Just the first line of accounting equation, right? So that's the basic knowledge. All right, so Sega will carry for the second half.
Good morning, everybody. I'm going to be taking you through questions 18 to 33 of the midterm. We'll start with question 18 here. So this question, we're still on chapter 3 here. It tells us that the adjusted trial balance for the little company as of December 31st is presented below. Gives you a lot of accounts and their balances, and it asks you to calculate net income. So the answer is A21. Let's take a look why. I cut out a few snippets from the chapter 3 slides over here, which just defines net income, revenues, and expenses.
we've seen this a lot already through the questions that we've looked at, so let's jump in. I copied down the table over here and I highlighted the section that you get net income items from. So you can see over here we have service revenue, which is a revenue, and then we have a number of expenses. So this question is pretty straightforward. All you have to do is go ahead and take the revenue amounts, in this case service revenue for 57, and we're going to subtract out each one of these expenses. So we have $19 for salaries, we have $11 worth of advertising, and we have $6 worth of utilities to get us to net income of 21. This is straightforward. I can give you guys a couple of tips on questions like this. So normally, this is not a hard and fast rule, so I wouldn't memorize this and try to apply it everywhere. But when you see statements of accounts, this in this case is an adjusted trial balance, which is different from a balance sheet. It's normally internal use. It's not necessarily in your financial statements, and your investors are looking at it very carefully. So they're not always presented in the same exact format. But typically, let's say you're on a question like this and you're a little bit stuck. Somebody before mentioned dividends, for example, and that's something that commonly gets confused for an expense. But it's actually not an expense. It's a return of capital. So if you saw dividends over here, that might be a little bit confusing and you might not know. So sort of, I can give you a tip as a tiebreaker. Like normally you should know what net income items are in terms of revenues and expenses, but if you're a little bit confused sometimes and you want a little bit of a clue, if we look over here, let's go through the accounts. We start off with cash, which is an asset. Then we have accounts receivable and land, more assets. Then we go to accounts payable, that's a liability. That's followed by our stockholders' equity accounts, common stock and retained earnings, and then we get into the income statement. So again, because it's a trial balance, this is not necessarily always going to be the case, but it gives you a little clue in the order. So we start off with assets, that's followed by liabilities, and then we have stockholders' equity. If we saw dividends here, they'd most likely be listed right after retained earnings and right before service revenue. So sometimes if you're a little bit confused about something and you just kind of are desperate to make sure, one way to know is checking the order could be a little bit of a clue sometimes when it comes to financial statements. Okay. That's clear. We'll move on to question 19. Yeah, sure. What are you looking for? And this lecture is being recorded, and it's going to be posted online after. So if you guys want to go back and look at any of the detail that I had in the slides, you can always watch the video and just pause it at that section and then recopy notes. So you don't have to be too desperate to copy everything down right now if you can't get to it. Okay. Question 19 says, sales returns is an example of blank account, which is used to keep a record of reductions from revenue due to sales returns separate from total revenue itself. So it gives you 4 options for what sales returns might be categorized as. Here's another snippet from your Chapter 3 slides. It says, net revenue sales is actually total revenues less any amounts for discounts, returns, and allowances. So you guys are pretty familiar with revenue accounts at this point, but throughout the textbook, there's mention of these contra accounts. And the way contra accounts are used, so normally in accounting, if we have an amount in an account, and then that account needs to be reduced, we don't just take that number and reduce it. Usually there's another account that keeps a record of reductions to that main account, and those accounts are called contra accounts. So in this case, net sales is a revenue account, and reductions to this revenue account are achieved via discounts, returns, and allowances. So the answer here is that sales return is an example of a contra revenue. Does the concept of contra accounts make sense to everybody? Basically, the idea is you want to keep a record of all your transactions when you're bookkeeping. So if you just take an amount and you change it just by lowering it and sometimes increasing it, you kind of lose a record of the transactions that happen. So you want to keep your total revenues, the amount that you actually charge your customers and you actually expect to get payment for. Then any returns after that should be accounted for separately, and they get accounted in a separate contra account, which then gets netted against your sales to give you a net sales number at the end of the day. So you can go back and have a full record of every transaction that happened, the sale and the return. Moving on to question 20. Company sells goods to a customer on account for $800, terms 310, net 30. The customer pays within the discount period. On the date of payment, the company will debit. Okay, so now we're moving on to Chapter 5 over here. In your slides, there's an example of the exact journal entry that takes place for this kind of transaction. But first, I wanted to get you guys familiar with the concept of discount and the way it's usually written out, like in this case, 310 net 30. So a sales discount represents a reduction in the amount to be paid by a credit customer if the payment is made within a specific period of time. So in your slides, you have an example that says the discount terms are 210 net 30. What that means is that the customer gets a 2% discount if they pay within the next 10 days. But the total amount, if they don't take the discount, is due within the following 30 days. So a total of a 30-day period, and within the first 10 days gets them a 2% discount. So that's pretty straightforward. In this question, we have 310 net 30, which means a 3% discount if they pay within the first 10 days, and the full amount is due within 30. In here, we know that the customer paid within the discount period. The question tells us that. So first, we have to calculate the discount. The price of the product is $800. So let's just throw in 800 here. And then the discount rate is 3%. So I'm going to pop in a 0.03, and that's $24. So the customer here is getting a $24 discount on the $800 sale. So if you go back to what the question is asking, it says on the date of payment, the company will debit. So date of payment, this is after the sale has already been made, and now we're actually the company's actually receiving cash from the customer. So before we get there, let's give you the full picture a little bit. So let's do the journal entry for the actual date of sale as well. So on the date of sale, the customer is paying us. They're not paying us yet. The sale is made on account. So accounts receivable will be debited for $800, and sales revenue will be credited for $800. Then, on the date of payment, sometimes I think it's good to just do the initial entry too, so that you could see which accounts are getting reversed later, and so that you don't often, it's a little bit hard to, it's easy to confuse things when you just do one part of the entry. When you just do the date of the cash payment, you might think, oh, well, that's revenue because they're paying us. But if you think about it and you do the initial entry and you see, oh, I've already credited revenue, you know that can't happen again. So I don't know how many questions are on your exam, but I think it's 2 hours. But do you know how many questions? Okay. So this test, I don't know the comparable difficulty between your midterm and this one, but you have an idea of how long it takes you to do 33 questions. So how much time you're going to spend on doing additional journal entries is up to you. It depends how quickly you do these things and how comfortable you are. But I would recommend saving like the additional steps for the questions that you're not really sure about. If you feel really confident about it, go ahead and do it. And then if you have extra time at the end of the exam, then you could always go back and do the additional journal entries as a self-check to make sure that your answers were correct. But that's sort of the strategy I would advise you to employ. So on date of payment, we know that we had accounts receivable before, so now we're going to credit the accounts receivable for $800. And now a big clue into the sales discount here is that the customer paid within 10 days. So you know they're not going to have to pay the full amount. So it's it wouldn't be correct to put $800 in cash. So we know our sales discount is 24. And to balance this entry, we know that we're going to need a 776 here. And we can see now the total of the debits match the credits, 800 and 800. So this is the full journal entry. And a lot of the choices here refer to that journal entry. So partially by process of elimination, or you can just look at this journal entry and see the sales discount amount is $24, and that's what's being credited here, debited here, sorry. And they're asking about the debit. So just so you guys can see illustration of a contra account, like I mentioned previously, we had sales of 800, and now our sales discount account has 24. So our negative. So our net sales we see over here is 776. Hopefully that's clear. Now, I had a couple of tips about this question too. So sometimes, again, if you're not sure, I wouldn't spend time doing this. If you write the journal entry out and you're pretty confident about it, go ahead. But let's take a look at the other choices and see why they might be wrong. If you're not sure, sometimes it helps to eliminate another choice or two. So there's a few reasons why the choices could be wrong. And a lot of times the choices are put here for good reason. They're usually not just random numbers or random accounts. Usually the accounts or the amounts are involved in some kind of way, and the exam is looking to make sure that you don't confuse those things. So we saw that accounts receivable, it says the company will debit accounts receivable for 776. So over here, we're looking at the wrong account. We're actually debiting cash for 776. Another choice is cash for 800. So over here, it has the right account, but the wrong amount. So we know that that's not right either. And choice D has sales revenue for 800, and that's the wrong account. So a lot of times, the choices will look good in one way or another, but they will have something wrong with them. So if you can, for yourself, either eliminate the wrong amount or the wrong account or the wrong direction, like a credit or debit, if you can figure out any one of those things related to each one of those choices, then it'll help you eliminate the choice. Question 21. Under the allowance method, companies are required to estimate future uncollectible accounts and record those estimates in the current year. Estimated uncollectible accounts, and it gives you 4 choices in reference to how they affect assets and net income. So this slide is directly from your notes. There are 2 methods for doing this, if you guys remember. There's the allowance method and the direct write-off method. There's also a slide following that one that has the allowance for uncollectible accounts, and it takes you through a pretty detailed example of how the entries look. I highlighted the entry here. So we credit bad debt expense, and we debit bad debt expense, and we credit allowance for uncollectible accounts. So in this case, I put down here the actual journal entry. Under the allowance method, this is what it's going to look like. So allowance for uncollectible accounts, this is a contra account to accounts receivable. And we see that it reduces assets because we're crediting the contra account, and it increases expense, which thereby decreases net income. So the answer we're looking for is decrease assets and decrease net income, and that's choice D. Some of these questions are, you can think of them as memorization, some of them are calculation, but when it comes to the memorization questions, if you're memorizing too much for this exam, I mean, you have 4 chapters and the chapters are long. If you're just trying to memorize rule after rule, it's going to be overwhelming and it's going to be too much. So if you can try to understand the reason behind the rule, like understand how the journal entries work, where if you saw a transaction that you've never seen before, if you could write out the journal entry based on how you know previous transactions work, based on the direction that assets increase, debits and credits, and what items are part of net income, those kinds of things will help you, and all the less to memorize. The only things you should be memorizing are specific regulations or like very small rules that maybe don't otherwise have an actual transaction related to them. We'll see some examples of that later on here. But even in those cases, there's reasoning behind the rule. So if you can, sometimes it even helps to Google why a rule is a certain way. I'll give you an example of that later, but it just creates a little bit less to memorize. Okay. So now we're on question 22. Samsung Company creates the following accounts receivable aging report at the end of the year. The balance of the allowance for uncollectible accounts before adjustment is 5 million credit. Use the information above to calculate the estimated ending balance in the allowance for uncollectible accounts. Okay, so in your slides, there's 2 methods here. We talk about percentage of receivables, and this is sort of like a sub-method of that, is aging of receivables, where we create an aging schedule based on how old each one of our receivables are. So there are slides which go through this. The slide following this one actually has an example of the following month and adjusting entry to, so you can go back to the slides for detailed examples on that. Let's look at the data we have in our specific question. I copied the table down here, so let me see one for you. So the first step is to estimate the amount uncollectible. Now, this is pretty straightforward. If you do a couple of examples of this, you'll get used to it very quickly. But we have account ages here, and we have the amounts here, and our estimated portion that's uncollectible for each age. So all you have to do is multiply the amount by the rate that we think it's uncollectible. So for a 0 to 60-day account, that's $20 million times 15%, or 0.15. So we can go to the 20 here, and I'll just multiply it by, let me just do 0.15. Copy this down. So we have $3 million is considered uncollectible for our first set of accounts, which is 0 to 60 days old. And for our next set, we have 10 million, and we're going to multiply that by 0.25. For our next set of accounts, we have 5 million, and the rate at which that's uncollectible is 50%. And for our last account, we also have 10 million, and that's uncollectible at a 80% rate. That totals to 16 million. So we see that we have 45 million in accounts receivable, but we don't expect to collect about 16 million of that. So that's what we estimate for our amount uncollectible. Also a good tip, whatever calculator you're going to bring to the exam, make sure that you're used to using it. And a lot of them have memory functions. If you're going to use, like if you don't want to write down full tables, make sure you get comfortable with all that. And also just sometimes if you have extra time, you can go back and sort of do like a reasonableness check. So if you calculate, your estimated uncollectible accounts at, 90 million or something, and you see, oh, accounts receivable is only 45, that doesn't really make a lot of sense. So you can look at the percentages, see, okay, they average somewhere around there, 16 sounds reasonable, then you should be able to move on. Now, this question could be a little bit tricky. Let's take a look at what we're asking. And I recommend that you do this for all the questions. I think one of the most frustrating things about an accounting exam is that you can know how to do it, but so many different things can be asked from the same set of data. So what'll happen is if the question is worded in a certain way, and by the time you're done with the calculations, you forget what they're asking, you may pick the wrong choice. So always do a quick look over and say, what is this exact thing they're asking? After you write the journal entries, after you write your tables, and you have your calculations, just make sure you're looking for the right thing. What they give you here is, we have the total amount of uncollectible accounts, and they give you the prior balance. If you look over here, they say, before adjustment, the balance and allowance for uncollectible accounts is $5 million credit. So now we see that we have 16 million after we do our calculation. So you might be tempted to say that, okay, we need an adjustment of 11 million. And that is actually one of the choices here, 11 million. But what they're asking for here, actually, if you're very careful, is use the information above to calculate the estimated ending balance. So the ending balance is actually what we already calculated. We would need an adjustment of 11 million to the account, which would get us to an ending balance of 16, which is the number that we calculated. Another clue is that you have all different ages of accounts receivable here. So you know that you're not going to have accounts receivable from the prior year having to move forward. That's already included in these accounts here. That original 5 million was the previous amount for uncollectible accounts, and now we're just adjusting that amount to 16 because all of those accounts are relatively older than they used to be, and we have some new ones. So the answer here is choice C. Question 23 is related. And if this happens on your exam too, sometimes it should open your eyes to the fact that maybe you did something wrong in the previous question. If a lot of the questions, if you get 2 or 3 questions in a row that work on the same data set, then they're usually going to be asking you about different parts of the data. And if you end up thinking that the answer is the same to 2, just double check that. Because odds are they're asking different things in each question. So question 23, Samsung Company would record the year-end adjustment of what? And so we can go right back to our last question where we said our estimated uncollectible accounts, our ending balance was 16, and it gave us the information that our beginning balance was 5. So the adjustment to plug in here is 11 to get us from 5 to 16, and that's the answer for question number 23. Just if you're curious, sometimes the answer could be the same for both. Like for example, if our estimated uncollectible accounts are 16 million, but our prior balance was 0, then our adjustment is 16 million and our ending balance is 16 million. So you could see questions like that too. Question 24, writing off an account receivable using the direct write-off method includes a debit too. So along the same lines as the last few questions we did, there are 2 methods. There's the allowance method and the direct write-off method, and this question is asking about the direct write-off method. So the direct write-off method is actually not a GAAP method, but the difference between here and the allowance for uncollectible accounts is that you're not anticipating the lack of payment by the customer later on. You're actually waiting until you know they're not going to pay. Let's say the customer files for bankruptcy, for example. Then what you do is you debit bad debt expense and you credit accounts receivable. This is not GAAP because odds are you know that a portion of your accounts are going to be uncollectible at some point, so you're required to estimate that. Now, if you wait till the customer actually doesn't pay, then accounts receivable is overstated throughout the life. So that's why the allowance method is more appropriate. But you should know the direct write-off method too. So I put a little guide here as a comparison of the two. So you can see that in both methods, we're debiting bad debt expense. And they happen at different times. So the allowance method happens in anticipation of that. But the difference in the entry here is that the allowance method, you credit the allowance for uncollectible accounts, and the direct write-off method, you directly credit accounts receivable. So that's the difference between the two methods. So in this case, that leaves us to the direct write-off method includes a debit to bad debt expense. Okay, now we're moving on to chapter 6. This chapter is about inventory. So question 25 says, it's just a definition question. It says inventory is typically reported as and it gives you 4 choices. So I copied the slide from your notes that defines inventory as a tangible property held for resale or use in producing goods or services, and it tells you that it's on the balance sheet as a current asset. Just a reminder, the difference between current assets and long-term assets. Current assets are expected to be used within the next year, and inventory is specifically an item that you plan on selling for revenue, and usually that's very quickly. So they're typically recorded as a current asset. So this is straightforward, choice C. Question 26. Travis Corporation begins the year with $50,000 of tire inventory. The company purchases tires worth $150,000 during the year. At the end of the year, the purchase cost of remaining inventory is $30,000. What is the cost of goods sold? Okay. So the next few questions are going to involve cost of goods sold. So I put the formula up here. This is also from your slides. This is chapter 6 we're looking at now. And this formula, we'll go into depth on this formula in the next few slides too, but cost of goods sold is beginning inventory plus purchases minus ending inventory. So to calculate cost of goods sold, they give you a bunch of data items here. Normally, if I see questions like this, I write down all the pieces of data and I try to understand how each one is used so that way I'm not missing a piece later on that I have to go back in. So cost of goods sold is beginning inventory. Beginning inventory over here is given to us as $50,000. Purchases of $150,000 get added to that. And our ending inventory is subtracted from that amount. They tell us our ending inventory is $30,000. And that gives us cost of goods sold of $170. And that's choice D. Over here, I wrote out another way to illustrate this. Some people, these formulas are not so intuitive until they see them more visually. So if you think of this in sort of a timeline, you start out with your beginning inventory, whatever's already in the warehouse. Then you have purchases throughout the year that you're adding to that stock. So then between the beginning inventory and everything you purchase throughout the year, that gets you to what's known as total inventory available for sale. So that amount then has 2 components. You can only do 2 things with that inventory. You can either sell it or it remains in your inventory at the end of the year and thus your ending inventory. So your beginning inventory and your purchases are always going to add up to the combination of your ending inventory and your cost of goods sold. Your cost of goods sold is everything that you sold, and ending inventory is everything that's left. So if you can kind of visualize inventory available for sale into these 2 components, it'll be a lot easier to figure out how to work around these formulas. And you'll be able to like shift the numbers however according given the data that you're given. So either way, whichever way makes more sense for you to think of it, I recommend going with that way. So sticking with that topic, question 27 gives us the inventory transactions of Green Products, Inc. So again, we have beginning inventory. This time we have multiple purchases, so we'll have to combine those. The reason why they're listed separately is because we see that the unit cost is changing here. So because the unit cost is changing, the question is probably going to have something to do with the costing methods for inventory, and it also gives us the number of units and the number of units sold during the year. So question 27 is, what is the amount of cost of goods sold that Green Products will report in its income statement for the current year if it uses the first in, first out cost method? So this is a costing method question. If you recall from the slides in chapter 6, there are multiple inventory cost flow methods. There's specific identification, weighted average, and then first in, first out, which is known as FIFO, and last in, first out, which is known as LIFO. We're going to go into these a little bit more in depth, but just to recap what they mean, specific identification is the one that's very rare. In the actual industry, you don't really get used to this a lot, but it's when every single product that you have is marked individually, and when you sell that product, you know how much you bought it for. Now, that's not really going to work in high manufacturing companies. Coca-Cola is not tracking every can of Coke and seeing how much the aluminum costs for that can specifically. So that method is very costly. It takes a lot of time and effort, so it's not commonly used. Weighted average averages the costs of all the products throughout the year. FIFO is first in, first out. We're going to see illustrations of FIFO and LIFO, so I'll leave those here. The slides also go into full detailed illustrations of each method, so I suggest reviewing those if you're not comfortable with this yet. I wanted to recap on the table from the previous slide. So just as a reminder, because again, we have the question gives us beginning inventory, purchases. We'll have to calculate ending inventory in this case. First, let's try to figure out our total inventory available for sale. Now, to do that, we're given, I copied the table from above. So we're given beginning inventory plus 3 separate purchases and the cost for each one of those. So very simply, what we have to do is, So over here, we have the number of units of beginning inventory is 500, and the unit cost is $5. So we just have to multiply one by the other. And so here we're going to have 500 units at $5 gives us $2,500 is the cost for our beginning inventory. Similarly, we can do the same with our first purchase of 1,000 units at $6 gives you $6,000. Our next purchase of 500 at $7 is $3,500. And our last purchase for the year was 2,000 units at $8, which gives you $16,000. So our total inventory available for sale is $28,000. Now, that entire $28,000 is going to go either for cost of goods sold or ending inventory. So the next step, we have to look at the units sold during the year to figure out, the question is asking our cost of goods sold using the first in, first out method. So we sold 3,000 units during the year. So first in, first out means that normally we would have a problem here. We sold 3,000 units, and because we're not using specific identification, we don't know which of the 3,000 units we sold. So we have to assign costs for that. And depending on whether we say that the units came out of this purchase or beginning inventory or this purchase is going to change the amount that we assign to cost of goods sold. So first in, first out is one of the methods that we can use to do that. So we know that we sold 3,000 units during the year. First in, first out, we're going to start with the very beginning inventory and our very first purchases until we get to that 3,000 number. So our beginning inventory is 500, so we're going to need all 500 units of that. Then our next purchase is 1,000. If we add that, now we're up to 1,500. We're still 1,500 shy of what we have sold. Our next purchase gives us another 500. And now because we're up to 2,000, we need 1,000 more units from our final purchase to add up to the 3,000 that we sold. So you can see we're designating our 3,000 units as the first 3,000 units in our inventory, which leaves 1,000 units of this last purchase still in inventory. So then cost of goods sold, really simply here, is just So cost of goods sold over here under the first in, first out method is going to be the number of units sold in this column, and we're going to multiply by the unit cost for each one of those. So then, just like above, we have 500 times 5, 1,000 times 6, 500 times 7, but instead of 2,000 times 8, we have 1,000 times 8 because that other 1,000 is not part of the units that were sold. That adds up to 20,000. So this is our cost of goods sold under the FIFO method. So in this case, because we sold 20,000, you know that our ending inventory left under the FIFO method would be 8,000. We'll see how that changes given the different methods in the next few questions. But cost of goods sold being 20,000, the answer is choice C. Any questions about that? That was long, but we're going to see like a similar iteration in the next question using a different method. Okay, so the next question says, what is the amount of ending inventory that Green Products will report in its balance sheet at the end of the year if it uses first in, first out cost method? So this question, luckily enough, works off our previous question, and it just wants to know the ending inventory. So if we go back here, we had our cost of goods sold was 20,000, and our total inventory available for sale was 28. So that's going to leave us with ending inventory of 8,000, like we stated earlier. But I wanted to take you guys through these formulas. You might have seen these formulas in different forms throughout the slides, but I copied a few instances where I saw it. So you can try to memorize the formula for ending inventory and know that it's beginning inventory plus purchases minus cost of goods sold. The cost of goods sold formula, which we saw on the last slide. These are all just different forms of the same equation. So the equation is probably most intuitively seen this way: beginning balance plus purchases minus cost of goods sold equals ending balance. So you don't have to go and try to memorize all these equations. You can algebraically move the terms around from one side to the other to know ending inventory subtracts cost of goods sold and things like that. But if you can try to remember it as a timeline, that's always going to help you figure it out if the formulas are not easy to memorize for you or they don't stick in your head. So for this question too, I also have, so you could do this using the chart that I gave you earlier. And over here, we had total inventory available for sale of 28,000 minus our cost of goods sold left us with 8,000. If you're more comfortable with the formulas, we'll work through that. So ending inventory is going to be beginning inventory, which was our 2,500. Actually, let me just use formula so you could see where I'm going. Our beginning inventory was the 2,500. Our purchases is the sum of all three of these. And our cost of goods sold, we calculated in the previous table, is 20,000. And so our ending inventory, if we take beginning inventory, add purchases, and subtract the cost of goods sold, gives us ending inventory of 8,000. There are two different ways to approach the same question. All right, we're on question number 29. When inventory costs are rising, the blank results in higher reported inventory. So here's a slide that covers all the different attributes of LIFO and FIFO and why we use, what the motivations are for using each one. So there are advantages and disadvantages to both. Now, you can, again, try to memorize this chart. To me, that's not the best approach to take here. So let's think a little bit about why they create the advantages that they create. So just quickly, in our example, the costs were rising. They started at $5, and by that October 25th purchase, they had risen to $8. Now, costs rising are the most common scenario. We have inflation, and typically as time goes on, products are worth more. So the payments for them will be larger. There are certain industries where costs tend to fall. So falling costs would look like this. If we started off in our beginning inventory higher, and then the cost consistently dropped until our final purchases. So intuitively, if you try to understand this, FIFO is always using inventory from our beginning part. So if costs are rising, the cost of goods sold will be less than they would be under LIFO. LIFO is going to focus on the latter part of this. So the cost of goods sold is going to be made up of this. So our cost of goods sold will be higher, and our ending inventory will be lower. So if you want to, you can actually take this example and try to fill out this chart yourself. And just as practice, say, okay, FIFO, cost of goods sold, try to see in your own head, okay, this is lower, which has to make the inventory balance higher. If cost of goods sold are lower, that's going to make our income higher. And if our income is higher, then our income taxes will be higher. So each one of these things leads from the other. So if you could try to understand why, and because of these advantages, certain firms will use one or use the other. Sometimes they also use it because it just matches their actual order of inventory better. So if their products, their older products actually get shipped out first, that actually might be easier for them to track that way. So there are different motivations, but if you can understand the concept behind this, then you don't really have to memorize these kinds of tables. Okay. So here's one of the rules I was talking about earlier. The LIFO conformity rule requires that, and this is direct from a slide. In Chapter 6, it says LIFO conformity. A company that uses LIFO for tax reporting must also use LIFO for financial reporting. Now, you can go ahead and memorize that rule. If you're confused by things like this sometimes, I know not everybody here has experience with tax reporting. You probably haven't taken a tax class yet. I don't know if you've even filed tax returns yourself yet. But there's reasoning behind all these rules. So if you could figure out that reasoning, even if you want to Google it and see, hey, why does the LIFO conformity rule exist? You'll get some theory behind it, and that'll help you actually memorize these things. So the idea here is that they both have different advantages and both have different positives and negatives. So the question is asking, what is the LIFO conformity rule? And we said that a company that uses LIFO for tax reporting must also use it for financial reporting. Now, why is that? The main reason why that is LIFO conformity rule is an IRS rule. So the IRS knows that a lot of people rather use LIFO on their tax returns when reporting their tax returns because that'll lower their income taxes. But typically, managers want to use the FIFO system in financial reporting because they want to show higher earnings, and net income is higher under rising prices under the FIFO method. So the IRS wants to make sure that you're not trying to take advantage of them by using one method on your financial statements to make your income higher, but then on your tax return pretending to use another method and lowering your actual taxes. So that's why the LIFO conformity rule exists. There is no FIFO conformity rule. Now, if you think about it, that should be pretty intuitive because if you use FIFO on your tax return, then you're going to report higher taxes. You're going to need to pay higher taxes, in which case the problem kind of solves itself. People don't opt for higher taxes when they don't have to. So you're not really going to have people that are using LIFO on their financial statements but then purposely using FIFO on their tax returns just to pay more taxes. So that problem kind of takes care of itself. So there's no need for a FIFO conformity rule. Question 31. Tune Store reports inventory using the lower of cost and net realizable value. Information related to its year-end inventory appears below. So it gives you three different models of inventory, their quantities, their costs, and their net realizable value. So net realizable value, I copied a slide here from your notes. And I wrote a little note here. When inventory falls below its original cost, companies are required to report inventory at the lower net realizable value. Now, this follows the conservatism principle, which has probably come up a lot throughout the slides. But accounting tends to be conservative, and wherever they can, they try not to over-report income. So the idea here is that at some point, your inventory loses value. Let's say your warehouse gets flooded, and now you have a bunch of inventory that's not usable, and you have to write that down. You should no longer be reporting that inventory at its full cost, at its full original cost. So when the net realizable value goes down, then we need an adjustment. If the net realizable value goes up, you don't do anything because accounting is conservative, and that it's net realizable value is not super verifiable. So if you know that it went down, you're more likely to you should be forced to report it. But if it goes up, that may just be manipulated by you and your own estimates. So we don't allow companies to write up their inventory. Instead, they're only allowed to write it down. So if you remember the conservatism principle, it'll guide a lot of your adjustment processes. So if you're confused about that, a lot of times just think about accounting as being a conservative field. So we need first to figure out the lower of costs or net realizable value. So that's very simple. So let's just go through each model. So model A, the unit cost was 100 and the net realizable value is 120. So we have to report the lower of those two. In this case, that's the original unit cost, which is 100. The question's asking about model A, but let's just do it for model B and C too. So for model B, the lower of cost or net realizable value here is 40. The net realizable value is actually lower than the original unit cost. So we're going to have to use the price of 40. And for model C, net realizable value has gone up. So the unit cost is lower, so we're going to use that. So now we're going to be reporting inventory for model A at $100, and Model B at 40, and Model C at 200. So Model A quantity times the lower of cost or net realizable value gets you to $10,000, and that is choice A. Okay. The next question follows from that same set of data, and it asks you to calculate the amount to be reported for ending inventory of Model B. So luckily, we already saw that the lower of cost or net realizable value for that one is 40. So in this case, we're going to take the number of units that we have, and instead of using the unit cost, we're going to use net realizable value because that's lower. So 50 units times $40, that gets you to 2,000, and that's choice A. Okay, the final question is about the same topic, and it says, when a company determines that the net realizable value of its ending inventory is lower than its costs, what would be the effect of the adjustment to write down inventory to net realizable value? So now they're not asking you to calculate it, they're asking you what the actual entries are. So here's the slide that summarizes the entry. This is in Chapter 6, and it tells us that adjusting entry is a debit to cost of goods sold and a credit to inventory. So the slides always give you these little clues in most of the entries, I think. So it tells you that a credit to inventory is a decrease in assets. Inventory is an asset, and when you credit it, we're lowering that. Cost of goods sold is an expense, so that's being increased, which thus decreases your retained earnings. So if we look at the question, we have decrease in total assets. So is that happening here? Yeah, we're crediting inventory, so we are decreasing total assets. Decreasing net income. We have an expense here, so that does decrease net income. And decrease in retained earnings, we have that too. Expenses are going to decrease retained earnings. So all of these answer choices are correct. That's D. Now, just to, if it helps you guys, just to further illustrate a little bit, I have the previous question as an example of this. So what the journal entry would look like there. So we had our original costs of 100, 50, and 200. Which led us to a total cost of goods available for sale of $16,500. Now, after we make our adjustment for lower of cost or net realizable value, if you recall, we used 100 for Model A. We had to go down to 40 for Model B, and we stayed at 200 for Model C. So those are written here. So now our new costs are 10,000, 2,000, and 4,000. So you could see that our previous inventory, which was valued at 16,500, has now been reduced to 16,000. And you could see that $500 difference is driven entirely by Model B, which is the only one that we needed an adjustment for. So we went from $50 to $40. That's a $10 decrease for 50 units, and that's why the difference here is $500. 50 units times a $10 increase. So the $500 difference now will be debited to cost of goods sold and credited to inventory, just like the journal entry stated here. Okay, so that's the last question. Good luck to everybody next week.